Welcome to the Deep Dive, where we cut through the noise and get you genuinely well-informed fast. Today, we're plunging into, well, a market paradox that's just begging for a closer look. How often do you see Wall Street analysts overwhelmingly bullish on a company, projecting significant upside, yet over a quarter of its stock is actively being bet against by short sellers?
It's pretty unusual, yeah. A classic standoff.
That's CleanSpark Inc., trading on the NASDAQ under CLSK. It's a true battleground stock, and by the end of this deep dive, you'll understand exactly why and, what factors are going to decide who ultimately wins this fight.
It's a compelling setup, isn't it? On one side, you have a company branding itself as America's Bitcoin miner, scaling operations at just an incredible pace. On the other, a very significant chunk of the market is actively betting against its success. Our mission today is to really dissect CleanSpark's business model, scrutinize its management, comb through the financials, and assess the myriad risks and opportunities it faces. All our insights are based on data, financial metrics, and market indicators as of our analysis date, July 17th, 2025, when CLSK's closing share price was $12.60.
$12.60.
Got it. We're here to help you get well-informed quickly with hopefully some surprising facts and clear insights.
So with that fascinating paradox ringing in our ears, let's dive into the core engine of CleanSpark. Its business, the people running it, and the raw numbers.
Business analysis.
Okay, chapter 1, business analysis. To really understand CleanSpark, you need to know its core. They're what we call a pure play Bitcoin mining company. What does that term really mean for how they operate and, I guess, more importantly, how they actually make money?
Well, it means their focus is singular. Mining Bitcoin, think of it like this. They operate these vast data centers filled with specialized, high-powered computers called ASICs.
Right, the specialized chips.
Exactly. These machines are essentially racing against other miners globally to solve complex cryptographic problems. When they succeed, they validate transactions, add new blocks to the Bitcoin blockchain. Their revenue comes directly from this process. They get rewarded with newly created Bitcoin, which is the block subsidy, plus they get a slice of transaction fees from network users.
Okay.
So their revenue potential is inherently tied to two things: how much Bitcoin they successfully mine, and, of course, the market price of that Bitcoin. What's also interesting is their operational structure. They contribute all their computational power, their hash rate, to Foundry Digital, which acts as their sole customer.
Okay, Founder Digital. That paints a clearer picture of the revenue stream. So in practical terms, what exactly is their fundamental product or the service they provide to the market?
Well, their fundamental product is simply mined Bitcoin. As of June 30th, 2025, they've actually accumulated quite an impressive treasury of 12,608 Bitcoin.
12,600, wow.
Yeah, and their core service is providing that raw computational power, or hash rate, to the global Bitcoin network. That's their key operational metric. And they've scaled dramatically, hitting an operational hash rate of 50.0 exahashes per second, EHs, by June 24th, 2025. That's a truly staggering amount of computing power.
50 EHs, that sounds like a massive jump in scale. Where does that kind of operational muscle put them within the competitive landscape?
Oh, it places them squarely in the top tier. CleanSpark has rapidly ascended to become one of the largest and most efficient industrial-scale Bitcoin miners in North America. To give you some context, they were at just 9.6 EHs at fiscal year-end 2023.
Wow.
So to hit 50 EHs by mid-2025 is just explosive growth. It puts them right alongside heavyweights like Marathon Digital, MRA, and Riot Platforms, or IoT.
Okay, so they're big, they're growing fast.
Yeah.
For you, the listener, the investor, what's their core value proposition? What's the main pitch CleanSpark is making?
It's really built on operational excellence, capital stewardship, and monetizing low-cost energy to acquire and hold Bitcoin. A crucial differentiator is their infrastructure-first approach. They own and operate their data centers.
Ah, okay, that's key.
Yeah, this gives them direct control over costs and operations, which they believe optimizes performance and ultimately delivers superior returns. It's about being masters of their own domain, so to speak.
Makes sense. Let's talk about the broader industry. What are the big trends impacting Bitcoin mining right now? Feels like the ground is constantly shifting.
It absolutely is. I mean, the most profound impact recently was the 2024 Bitcoin halving. That cut block rewards in half.
Right, a huge deal for miners.
Huge. This has made operational efficiency, measured in joules per terahash or JTH, the absolute most critical factor for survival and profitability. It's an intense race to acquire the latest, most energy-efficient machines. Another strategic trend among some competitors is pivoting their infrastructure towards AI and high-performance computing, or HPC.
Right. We've seen companies like CoreWeave, Bitfarms exploring that, looking for alternative revenue streams. But CleanSpark explicitly decided to stay pure play Bitcoin, didn't they? What's the thinking there, and is it? Is it a good move?
Precisely. Management believes this singular focus provides strategic clarity. It offers investors a clear, Bitcoin-focused vehicle, but it's definitely a double-edged sword, right? It means foregoing a potential revenue hedge that could cushion them if Bitcoin's price stagnates or, mining profitability collapses.
So they're really leaning in.
Or amplifying their exposure to Bitcoin's fee, yeah. It's a high-conviction bet. On the more positive side, though, the institutional adoption and financialization of Bitcoin has surged, especially after the U.S. approved those spot Bitcoin ETFs. This has driven billions in capital inflows, which directly and positively impacts CleanSpark's revenue potential as a primary producer of the underlying asset.
Fascinating. So how cutthroat is the competitive landscape for these large-scale miners? It feels like it's a constant arms race. Yeah.
It is extremely fierce, and it's consolidating rapidly among these large, publicly traded North American miners like Mero, Riot, Core Scientific. The battle is fought on multiple fronts: securing cheap power, which is critical, acquiring land for new data centers, and being first in line to get the latest, most efficient ASIC miners from a, frankly, limited number of manufacturers. It's a constant scramble for advantage.
And what about regulation? That seems like navigating a complex minefield for these companies.
It absolutely is. The U.S. regulatory environment is a complex tapestry, really, of conflicting signals. On one hand, you have some positive political tailwinds. Certain politicians advocating for U.S. leadership in the industry push back against regs like the SEC's SAB 121.
Okay.
However, there's intense and growing scrutiny over energy consumption and environmental impact. ESG concerns are a major long-term risk. States like New York are doing formal environmental impact studies, and international bodies like the IMF have even discussed, a carbon tax on miners.
Wow.
This regulatory uncertainty creates a persistent threat of future compliance costs or operational restrictions. It's a constant balancing act.
All of that certainly sounds like exceptionally high barriers to entry for anyone trying to get into this business at an industrial scale.
Absolutely. The barriers are immense. You need massive capital, hundreds of millions, if not billions, for land, building out vast data centers, acquiring tens of thousands of expensive ASICs. Securing low-cost, large-scale power purchase agreements is a monumental challenge and utterly critical for profitability. And on top of all that, you need deep technical expertise to operate these fleets efficiently. It's not a business for the faint of heart or the shallow of pocket.
So given all that, what are CleanSpark's specific competitive advantages? How do they truly stand out in this crowded, cutthroat market?
Well, they've cultivated a strong brand, positioning themselves as America's Bitcoin miner.
Right, the trademark.
Yeah, it's a strategic move. It addresses geopolitical risk, especially after the China crackdown on mining in 2021. By emphasizing its U.S. base, they appeal to investors seeking, stability and domestic operations. Their most crucial claimed advantage, their moat, if you will, is their cost advantages and economies of scale. By owning and operating over 900 megawatts of infrastructure at massive scale.
900 megawatts.
Yeah, huge scale. They claim to achieve lower operating costs per unit of hash rate and actively manage power to optimize profit margins. It's about being lean and efficient at volume.
So their physical infrastructure is a big part of that moat, something hard for new players to replicate.
Precisely. While traditional network effects don't really apply like they might for, say, a software company, their formidable physical infrastructure, their own data centers, long-term power contracts is extremely difficult and costly for new entrants to replicate. And in terms of unique capabilities, they've really pioneered the ASIC option structure for hardware procurement.
Okay, what's that?
It basically allows them to lock in favorable prices for future deliveries of the latest mining machines. That's a significant strategic edge in a competitive market where hardware can be scarce and very expensive.
Gotcha. Okay, that makes sense. And just a quick reminder for everyone listening, you can like and subscribe to the Stock Analytics AI YouTube channel to stay informed on deep dives like this one.
Definitely helps us out.
Plus, members can add stock suggestions for future deep dives right there in the comments. We'll pick them up.
Management evaluation.
All right, Chapter 2. Management evaluation. Let's pivot to the people behind CleanSpark. Who's leading the charge and what's their track record been like, particularly given this aggressive growth story?
So the company is led by co-founder CEO Zachary K. Bradford and executive chairman S. Matthew Schultz, alongside CFO Gary A. Vecchiarelli. An interesting dynamic is the contrast in tenure. The executive team averages only about 1.5
Oh,
years.
quite new then.
Relatively, yeah. But the board of directors averages a much longer 8.1 years. This suggests a sort of stable, long-term governance structure overseeing a more recently assembled executive team. Their track record is really marked by two key achievements. One, that successful strategic pivot from being a small energy software firm to becoming a top-tier Bitcoin miner.
Right, quite a shift.
Huge shift. And two, consistent execution on aggressive growth targets, like exceeding their own hash rate guidance to hit that 50 EHs mark we mentioned. It's clear they are ambitious. Management even views bear markets as strategic opportunities to acquire distressed assets, which suggests a quite aggressive, almost predatory mindset.
Interesting. How transparent are they with communication, and what's their ethical reputation like, especially when it comes to executive compensation? That seems to be a hot-button issue for a lot of companies right now.
Yeah, definitely. On earnings calls, management projects a confident and strategically clear tone. They focus on operational excellence, specific metrics like hash rate, efficiency. They've generally been transparent, even acknowledging challenges like the direct impact of Bitcoin's price on quarterly losses.
Okay.
From an ethical standpoint, there are no major scandals that have come to light. However, a significant area of concern for many investors and a frequent point of contention is executive compensation. CEO Zachary Bradford's total compensation in 2024 was $15.44 million.
Yeah, 15 million. Wow.
This figure is significantly above average for similar-sized companies, and importantly, it increased even though the company remained unprofitable on a GAAP basis that's generally accepted accounting principles, the official way companies report earnings.
Oof. Yeah, that raises eyebrows.
It clearly raises questions about the alignment of executive rewards with actual shareholder value creation.
That certainly sounds like a point where the bulls and bears would clash. Let's delve into how they allocate capital. How do they invest, and what's their approach to shareholder returns, or maybe lack thereof?
Well, CleanSpark's capital allocation strategy is squarely focused on aggressive growth. They deploy the vast majority of capital into greenfield projects, basically building new data centers from the ground up, and opportunistic M&A, acquiring facilities or fleets of miners where they can leverage their operational expertise.
Right.
This grow-at-all-costs approach is a critical distinction from traditional value investing principles, which often favor businesses generating high returns on capital without needing constant, massive infusions.
Right, like a Buffett-style company.
Exactly. CleanSpark's model is inherently capital-intensive. It requires continuous, enormous investment in rapidly depreciating assets like those ASIC miners. It's more akin to a venture capital-style bet. Achieve massive scale and hope that scale, combined with Bitcoin price appreciation, will lead to outsized returns down the road.
So no dividends then, right? And what about share buybacks? Have they used those to return capital to shareholders?
That's correct. CleanSpark does not pay a dividend and has no history of doing so. All capital is reinvested into expansion. And while share buybacks have been discussed by management, particularly related to a convertible bond issuance they did, the dominant historical trend has been the opposite: significant issuance of new shares.
Ah, dilution.
Exactly. This has led to dilution for existing shareholders, effectively spreading the pie into more slices.
Okay. Given all this investment, how effective are they at actually generating returns on that capital? What does a return on invested capital, or ROIC, actually look like?
Yeah, ROIC measures how effectively a company uses the capital it has invested to generate profits. And for CleanSpark, it's currently negative. Fintel reports a trailing 12-month ROIC of -8%, and Morningstar reports negative 1.38%.
Minus 8%. Okay.
This negative ROIC is a significant financial sort of Achilles' heel for CleanSpark's bull case from a traditional value perspective. It indicates they are not yet generating a profit from their massive capital investments. The whole investment thesis relies on this being a temporary state, that these investments will eventually turn ROIC positive.
Right. That's the bet.
That's the bet. The crucial question for you, the listener, is when and if this inflection point will be reached. This figure, along with the consistent pattern of insider selling we'll discuss later, suggests that the massive capital they're pouring in isn't yet generating a profit, raising a fundamental question. Is this simply a necessary investment for future scale, or is it a deeper structural issue that short sellers are betting on?
Yeah, that's a key question.
Financial analysis?
All right, Chapter 3, Financial Analysis. Now, let's crunch some numbers and dive into the financials that underpin this whole operation. First off, what's CleanSpark's market capitalization?
As of our analysis date, July 17, 2025, CleanSpark's market cap is approximately $3.53 billion.
$3.5 billion.
Yeah.
Okay.
This positions them firmly in the mid-cap segment, but their operational scale and ambitious growth targets give them characteristics more typical of a larger player within their niche.
And what about their revenue growth?
Yeah.
We heard explosive earlier. Let's see the numbers that prove that.
It truly has been explosive. I mean, back in 2020, they reported $11.3 million in revenue.
Okay.
That jumped to $81.4 million in 2021, then $131.5 million in 2022, $168.4 million in 2023, and then a massive leap to $460.00 million in 2024.
Huge jump.
Huge. For the trailing 12 months, they're currently sitting at $530.0 million. This top-line trajectory clearly showcases both their rapid scaling and, crucially, their profound dependence on the volatile crypto market.
So massive revenue growth. But
Mhm.
what does that translate to in terms of profit margins? Are they actually making money on all this?
That's where the story gets more complex and where that battleground dynamic really emerges. Their gross margin, which is the profitability of their core mining operation, is highly volatile. It's directly impacted by Bitcoin price and energy costs. It was 57% in Q1 fiscal 2025, for example, but dropped to 53% in Q2.
Okay. Still pretty high gross margins.
Yes, but on a GAAP basis, their operating margins at negative 35.3% and net profit margins at negative 36.4% are consistently and deeply negative.
-35, -36%. So officially, they're losing money.
Officially, yes. These negative figures are largely due to massive non-cash depreciation charges on their rapidly depreciating ASIC miners and significant stock-based compensation.
Gotcha. And what about free cash flow? Are they generating cash from operations, or are they constantly needing to raise more capital just to keep growing?
Not yet. Due to their aggressive expansion, CleanSpark's free cash flow has been deeply negative. On a trailing 12-month basis, they reported cash from operations of negative $233.15 million and cash used in investing activities of negative $920.4 million.
Wow, almost $1 billion in investing activities.
Yeah, this signifies a substantial cash burn. They are very much in a heavy investment phase and are not yet generating self-sustaining cash flows. They're relying on external financing to fuel their growth. It's almost like they're, building the plane while flying it.
Yeah, seems like it. With those numbers, I imagine their earnings consistency is all over the map, making it hard to pin down their true performance.
You'd be absolutely right. Their bottom line swings wildly, almost entirely dictated by Bitcoin's price and those accounting treatments. For example, in Q1 fiscal 2025, they reported a GAAP net income of plus 0.095 cents per share, positive 85 cents.
Okay.
But just one quarter later, in Q2 fiscal 2025, they reported a GAAP net loss of negative 49 cents per share. Negative 49 cents, primarily attributed to a decline in Bitcoin's spot price.
Quite a swing.
Yeah, this extreme volatility makes traditional earnings-based valuation models exceptionally challenging for investors.
How does their debt look, and what about their short-term liquidity? Are they financially stable despite the cash burn?
Actually, pretty stable on that front. As of March 31st, 2025, their debt-to-equity ratio was 0.4.
0.4. That's pretty low.
Yeah, $766.5 million in liabilities versus $1.9 billion in equity. A ratio below 1.0 is generally considered conservative, so this indicates a moderate and generally healthy level of debt. They've strategically used this to fund growth, including a notable $650 million convertible bond. For liquidity, their current ratio as of March 31st, 2025, was an exceptionally robust 8.67.
Whoa, 8.67. That's huge.
It is. To put that in perspective, it means they have nearly 9 times more short-term assets than liabilities. So they're surprisingly liquid given their substantial cash burn, a true fortress balance sheet that maybe the short sellers are overlooking.
Interesting point.
And as we've noted, they don't pay a dividend.
Right. Let's talk valuation. With those negative earnings, I'm guessing traditional price to earnings or PE ratios are pretty much useless here, right?
Indeed. The PE ratio is currently of little use for CleanSpark and its peers due to their unprofitability. It results in negative PE ratios, typically between, say, negative 11 and negative 18.
Meaningless, basically.
Pretty much. Investors in this sector have to look at other metrics like price to sales, enterprise value to hash rate, and most importantly, their forward-looking sentiment on the future price of Bitcoin. It's a completely different rulebook.
So if traditional PE doesn't work, what about an intrinsic valuation like a discounted cash flow or DCF model? How do you even begin to apply that to a company so tied to a volatile asset like Bitcoin?
Yeah, applying a DCF to a Bitcoin miner like CleanSpark is exceptionally difficult because its future cash flows are almost entirely dependent on the highly volatile and unpredictable future price of Bitcoin. Any DCF valuation becomes less of a precise calculation and more of a sensitivity analysis, heavily relying on a wide range of assumptions about the crypto market.
So more of an illustration than a hard number.
Exactly. For educational purposes, an illustrative DCF model could yield a potential intrinsic value range of, say, $8 to $25 per share.
$8 to $25. That's a massive range.
It is, and it's crucial to understand this isn't a prediction, but an illustration of how dramatically the company's perceived value can change based on different outlooks for the cryptocurrency market. It's the ultimate choose-your-own-adventure in valuation.
That's a good way to put it. What are the key assumptions that drive that kind of volatility in the model? What are we essentially betting on?
Well, the growth rate is a complex function of CleanSpark's own hash rate growth, the overall global network hash rate growth, the future Bitcoin price, which is by far the most sensitive assumption, and of course, their operating costs. For the discount rate, the WACC, because of the exceptionally high risk and volatility inherent in the crypto industry, you'd need a very high rate, typically in the 15% to 20% range, to account for that elevated risk.
15 to 20% discount rate. Wow.
Yeah, it's essentially acknowledging you need a huge potential return to justify taking on that level of uncertainty.
All right. Having now dissected CleanSpark's internal workings, it's time to zoom out and see how the market is truly reacting to all this, where that battleground dynamic we talked about really comes into sharp focus.
Market sentiment.
Okay, Chapter 4. Market sentiment. Let's talk about how the market views CleanSpark. What are Wall Street analysts saying? And does their view align with the broader markets?
Wall Street's perception is, well, overwhelmingly bullish. Based on a consensus of 9 analyst ratings, CleanSpark carries a strong buy recommendation, nearly 89% of analysts rating it a buy.
Strong buy.
The average 12-month analyst price target is in the range of $18 to $20.50, with the full range stretching from $9 all the way up to $27. At the current price of $12.60, even the average target implies significant potential upside. It's clear they see a strong future ahead.
And what's the general media tone and recent news impact? Are headlines painting a similar picture?
Yeah, generally. Recent news flow has been predominantly positive, focusing on successful operational execution. Headlines from June and July 2025 highlight achievements like CleanSpark reaches 50 EH's milestone. Mining 695 BTC in June, its rapidly growing Bitcoin treasury.
So, positive momentum.
The media tone generally mirrors the bullish analyst sentiment, emphasizing the company's growth story.
So everything's coming up roses, right? But then why, despite all this positivity, is there such a huge contingent of short sellers? What are the market indicators telling us on that front?
This is where it gets really interesting and where the paradox lives. Despite the overwhelmingly positive analyst ratings and news, there's a significant and vocal contingent betting against CleanSpark. Short interest is exceptionally high. We're talking 70.28 million shares held short.
70 million shares short.
Yeah, representing a staggering 25.60% of the public float, over a quarter of the available shares.
It's enormous.
It is. The days to cover ratio is 2.26, indicating a deeply entrenched short position. This isn't just a casual bet. It suggests a high conviction from those betting against the stock. And of course, it creates significant potential for a short squeeze if the price moves strongly against them.
What about the stock's technical indicators like moving averages? Are the charts confirming this bullish narrative or hinting at trouble?
Well, from a technical perspective, the signals are generally bullish, actually. The stock's current price of $12.60 is trading above its 50-day simple moving average of $12.08.
Okay. Short-term bullish.
Generally considered so, yes. And it's also trading comfortably above its 200-day simple moving average of $10.27, which is a strong, long-term bullish signal for technical analysts.
Interesting. So the chart's from the bull side, too.
It seems so, adding another layer to this fascinating conflict.
So we have this fascinating and stark dichotomy. The company's management, bullish Wall Street analysts, positive technical indicators, versus a formidable army of short sellers. What does this all mean for the stock's future? Who's likely to be right?
It means this is not a case of an undecided market. It's two large, well-capitalized factions making opposing high-conviction bets This guarantees continued high volatility.
Yeah, definitely expect swings.
Oh, yeah. The ultimate victor in this battle will likely be decided not by incremental operational achievements, but by macro factors. The long-term price trajectory of Bitcoin and the impact of major external events like government regulation, international tariffs. An investor in CleanSpark is stepping directly into the crossfire of this battle, making a very direct bet on the future of Bitcoin itself.
Ownership structure.
Okay, Chapter 5. Ownership structure. Let's delve into who actually owns CleanSpark stock. What do the institutional ownership patterns tell us about who's holding the shares?
Well, institutional ownership is significant. It's approximately 59.84% of shares outstanding, with about 530 institutional owners. Large passive index fund managers like BlackRock, Inc., holding 44.6 million shares, and the Vanguard Group, with 24.1 million shares, are the largest holders.
BlackRock and Vanguard, the
Wow.
usual suspects.
Exactly. This is largely driven by CleanSpark's inclusion in major indexes, like the S&P Small Cap 600 and Russell 2000 ETFs.
That sounds like a big vote of confidence from some of the largest players in the market. But what about the people who know the company best? The insiders, the management, the directors. What have they been doing with their share?
Right, the insiders. They own a meaningful stake, about 3.3% of the company. CEO Zachary Bradford, for instance, owns 0.93%, valued at over $32 million, which you could see as positive alignment.
Okay, 3.3% isn't huge, but it's something.
It's something, yeah. However, the pattern of recent insider transactions tells a very different story. It's overwhelmingly one of selling. Over the last 12 months, there have been 33 open market sales by insiders, compared to only 16 buys.
More sales than buys.
Significantly more. And even more starkly, in the last 3 months, there have been 6 insider sales and 0 open market buys.
0 buys in 3 months.
0 open market buys. That selling totaled approximately $10 million in sales over the past year.
So how should we, the listener, interpret these conflicting signals? High institutional ownership versus consistent insider selling. It feels like we're getting two very different messages.
You absolutely are. And it's crucial to distinguish. The high level of institutional ownership, while appearing as a vote of confidence, is largely a passive signal.
Because of the indexes.
Right, exactly.
Yeah.
These funds are often required to own the stock to track their benchmark. It's not necessarily a high-conviction bet on the company itself. In contrast, insider transactions represent an active signal from the most informed players, those with the most intimate knowledge of the company's day-to-day operations and future prospects. A consistent pattern of insider selling, especially without any open market buys to counterbalance it, is a powerful and, frankly, difficult to ignore signal.
Yeah, it's telling.
So, for you, the listener, you should probably heavily discount the vote of confidence from passive institutional ownership and weigh it heavily against the more telling actions of the company's own leadership.
Risk assessment.
Okay, Chapter 6, Risk Assessment. Let's bring it all together with a strategic overview, using a SWOT analysis to break down CleanSpark's market position. What are their biggest strengths that the bulls are clearly betting on?
Okay, strength. First, operational scale and efficiency. They're genuinely large and getting more efficient. Second, that owned and operated infrastructure we talked about, giving them control. Third, a strong balance sheet and liquidity. The high current ratio is key. And fourth, strategic hardware procurement, especially with those ASIC option structures.
But no company is without its challenges, especially in a volatile industry like crypto. What are CleanSpark's key weaknesses that the short sellers are likely targeting?
For weaknesses, the biggest one is probably its singular dependence on Bitcoin. There's no hedging against price drops. Then there's the negative profitability and cash burn we discussed. Also, a history of shareholder dilution to fund growth. And finally, that high executive compensation, which raises those alignment questions.
All right, what about the upside? What are the big opportunities that could really propel CleanSpark forward?
Opportunities. Well, the single most powerful catalyst is simply Bitcoin price appreciation. If Bitcoin soars, so do they, likely disproportionately. Beyond that, favorable regulatory shifts in the U.S. could be a huge boost. There's potential for industry consolidation, allowing them to acquire weaker rivals at a discount. And continued technological advancement in mining hardware could further improve their efficiency.
And finally, the threats. What external factors, things beyond their control, pose pose the biggest risks to CleanSpark's future?
Threats. These are critical. We're looking at geopolitical factors, specifically things like tariffs. Energy price volatility is huge. It directly impacts their cost of operations. Increasing network difficulty as more miners join the network globally makes it harder to earn Bitcoin over time. And growing environmental ESG regulation could impose new compliance burdens or restrictions.
Let's zoom in on a couple of those threats because they seem particularly acute right now. How do macroeconomic factors like inflation, interest rates impact a Bitcoin miner like CleanSpark?
Right, so inflation is kind of a double-edged sword. On one hand, it can bolster the digital gold narrative for Bitcoin, which could be positive for CleanSpark's revenue if Bitcoin's price rises. But inflation also increases their operational costs, power, labor, part squeezing margins. Interest rates are typically more of a headwind for crypto-related assets. Higher rates increase borrowing costs for a capital-intensive business like CleanSpark.
Makes sense.
And they make lower-risk investments like bonds more attractive, potentially pulling capital away from more speculative assets like crypto miners. Conversely, falling rates would likely be a major tailwind.
And what about specific geopolitical factors like those U.S. tariffs that were implemented in 2025? How directly does that hit CleanSpark?
Oh, this is a very direct and acute threat. The 2025 U.S. tariffs on imported hardware, including ASIC miners, impose levies of 24% to 36%.
24 to 36%. Ouch.
Yeah. Since most of this hardware is manufactured in Asia, this significantly increases capital expenditure. A 25% tariff on an Antminer S19, for example, could add over $1,250 to its unit cost.
Wow.
Multiply that by tens of thousands of machines. It translates to millions in additional costs for CleanSpark's large-scale purchases. Companies have been scrambling to accelerate shipments to avoid these levies. While there's a potential long-term but maybe uncertain silver lining of incentivizing domestic ASIC manufacturing, for now it's a clear and expensive headwind.
Definitely a major risk factor to watch.
Conclusion.
So, Chapter 7. Conclusion. We've gone on a true deep dive into CleanSpark. Let's synthesize our findings and look at this battleground stock from both sides. What are the key points that define the bull case, the arguments in favor of the stock?
Okay, the bull case. First, best-in-class operations and scale, positioning it as a potential market leader in efficiency. Second, that fortress balance sheet with robust liquidity and manageable debt. Third, as a pure-play miner owning its infrastructure, it offers investors a powerful leveraged bet on Bitcoin's price appreciation. And fourth, it enjoys strong Wall Street support, with analysts overwhelmingly bullish.
And on the flip side, what are the key bearish points? What are the biggest concerns for those betting against it, the short sellers?
The bear case. Number 1, extreme volatility and a consistent lack of profitability on a GAAP basis, with that history of net losses and significant negative free cash flow. 2, those major external threats, regulation, energy prices, tariffs. 3, the pattern of insider selling and high executive compensation raises questions about management's alignment. And 4, the high short interest itself underscores the market's significant perceived risks and the deep conviction of those betting against it.
And to reiterate our valuation summary, where does CleanSpark's current price sit within that estimated intrinsic value range from our educational DCF model, keeping in mind how sensitive it is to Bitcoin's future?
Right. Our illustrative model, which is highly sensitive to long-term Bitcoin price assumptions, produced that wide estimated value range of $8 to $25 per share. CleanSpark's current share price of $12.60 sits squarely within the lower to middle portion of that range.
Lower to middle. Okay.
This wide range truly illustrates how drastically the company's perceived value can change based on different outlooks for the crypto ecosystem and, fundamentally, the long-term price of Bitcoin.
So what's the concluding outlook for CleanSpark? Is this a buy, a sell, or something else entirely?
Well, the investment thesis is sharply defined. This is a higher risk, high reward proposition. It's really less about traditional conservative value investing, which would likely be deterred by the negative profitability and cash burn.
Yeah, value guys would run screaming.
Probably. It's more about a strong conviction in the future of the Bitcoin network itself, coupled with a belief in this specific management team's ability to continue scaling in what is an incredibly challenging and unpredictable environment. It's a bet on the digital gold rush, with CleanSpark being one of the biggest prospectors out there.
And that leads us to our provocative thought for you, the listener, to mull over long after this deep dive is done. Given CleanSpark's grow-at-all-costs strategy and its reliance on continuous massive capital infusions into rapidly depreciating assets, consider this. Can CleanSpark ever truly achieve consistent traditional profitability? Or is its long-term value entirely dependent on Bitcoin's price appreciation, perpetually outpacing its immense operational and capital needs?
It's a great question. Really gets to the heart of the bull-bear debate. And if you found this deep dive valuable, remember that Stock Analytics AI offers priority access for members at just €4.99 a month. Over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access to these in-depth analyses.
Mhm.
If you're just looking for a one-off deep dive on a specific stock, you can always drop us a super thanks.
Finally, a crucial note. This analysis was generated by an AI system for educational purposes only and should absolutely not be considered financial advice.
That's right. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.